GETCRACK. Wake up, motherfucker.
The World Bank comes out with this list of the top 400 or 500. The USA ports are not hardly ever in the top 100.
That's Mario Cardera, CEO of the Port of Long Beach in California, America's second busiest port. It ranks number 9 in the world in level of activity, but number 373 in the list he refers to, the World Bank's annual Container Port Performance Index, which measures efficiency based on how long a ship stays in port. That index for 2023 ranked Yangshan, China, Salalah, Oman, and Cartagena, Colombia first, second, and third. The only U.S. ports that made the top 100 were Philadelphia at 55 and New York, New Jersey at number 92. Of the bottom 50 ports listed, 6 of them are in the U.S., making America's shipping infrastructure exceptional in the length of its delays. Turlock Mooney is the global head of port intelligence and analytics at S&P Global, which partnered with the World Bank to create the efficiency ranking.
Ports are critical to fluid supply chains. Efficient ports are extremely necessary to keep goods flowing smoothly. Efficient ports are actually catalysts for development. They attract investment, they attract logistics infrastructure, and they ultimately help to drive growth. Conversely, inefficient ports can have the opposite effect.
Time, as they say, is money. And when it comes to United States imports, it can be a lot of money, given the importance of consumers, which makes ports like Long Beach an indicator of the strength of the economy overall.
You have a great economy, and the American consumer is spending. In terms of Port of Long Beach, our numbers lately have been historic. So we're approximating now, after 9 months, we're up in terms of TE volume. We're up about 19% over and above last year's number.
To handle all that volume, ports like Cordero's Long Beach have been changing the way they do business, trying to make sure that they're as efficient as they can be, improving that low ranking in the World Bank Index. And some of that requires automation.
The research right now points to the fact that automation clearly is a cost reduction policy. For the Port of Long Beach, we're interested in productivity. As a global community, we've entered the fourth industrial revolution, so to speak, and that is the coming of robotics, automation. If you go back to a report that McKinsey issued back in 2017, they predicted that by 2030, we would lose 2/3 of American jobs as we know. For every robot that you put in place, there's 6 jobs that are limited. So I think for the Port of Long Beach, how we navigate that issue, as a public port, we have to consider all factors. And I think what we've been successful at, and when we do talk about automation, or in the case of Long Beach Container Terminal, semi-automation, we have that discussion as a stakeholder group, a collaborative effort.
Automation at seaports is not an all or nothing proposition. Loading and offloading ships and moving cargo from one form of transportation to another involves many complex steps, some of which are more readily automated than others, and some of which don't lend themselves to automation at all, given current technology.
The main benefit of automation, and the reason that it is the future, and the reason that you see the most efficient ports in the world automating operations more and more, is that it sits very well with digitization. So it's an important part of the technical foundation for interoperable data, sharing of data between different stakeholders, sharing of good quality data, so that action can be taken where necessary to drive efficiency and improve efficiency of port operations.
Automation is far from the only way that ports like Long Beach are seeking to improve efficiency. Indeed, it may not even be the best way. A better approach may be to get more productivity from the system the way it's now configured, particularly by extending the hours the port operates.
One of the things that I was very vocal about is how we move to 24/7 operations. Now, we're not working 24 hours a day, 7 days a week anytime soon. Imagine if you told the American consumer you can only fly during the week and the airports were closed on weekends, or you can only fly between the hours of 8 a.m. and 6 p.m. I mean, imagine what the airport bottleneck would be like. So I think the same emphasis needs to be put in terms of how we move cargo.
Another route to improved efficiency is rail. One train can carry 750 trucks worth of cargo. And earlier this year, Long Beach broke ground on a $1.5 billion expansion of its rail yard that will triple the amount of cargo it can handle annually. John Gabriel is Group President for Consumer Products at BNSF, one of the two railroads servicing Long Beach.
October of 2024 was the biggest single month moving intermodal that we've had as BNSF Railway. Tying that back to the ports, this year it's on a record pace for the most ship-to-train movements that we've done. It's the fastest we've ever gotten to 1 million containers loaded onto trains and departed out of the ports of LA and Long Beach. And I would certainly say that's a testament to, the investments we've made. Again, we've invested in tracks, facilities, more than $2.5 billion over the last 5 years. I think it's a testament to the collaboration we have with the ports of LA and Long Beach and the investments they've made. That's so important right now. Right now, we're handling more volume than we were post-supply chain crisis, where we saw the huge uptick in consumer demand, post-pandemic. And we're doing it about 50% faster from ship to train, and ultimately the ship to end destination across our intermodal network is about 75% faster than it was from a transit perspective back in 2022. And really, I would say the entire supply chain and all stakeholders have really stepped up, and it's really been a great demonstration of capacity and supply chain resiliency for all the goods moving through the West Coast.
Containers in Rotterdam are only 33% of the total cargo throughput. The major cargo, nearly 50%, is liquid bulk.
Half a world away, Hanna Stelzel is working on maximizing efficiency in Rotterdam, where she's the director of containers. It's the world's 10th busiest port and ranks 91st in the World Bank's efficiency index. As with Long Beach, Rotterdam is facing increasing demand.
We're expanding our container capacity. We do know from research that the container business in Europe will be growing. Actually, it will be growing all over the world. That has to do with containerization, that has to do with a growing middle class. And in order to prepare for that growth and to participate in that growth, we had decided to invest into our infrastructure.
Rotterdam is a leading port in a new system called Gemini, involving shipping companies Hapag-Lloyd and Maersk.
The trends that we see is that transshipment volumes are growing. That has to do, for example, with the fact that we have hub-and-spoke concepts that are being introduced. Maersk, together with Hapag-Lloyd, introduced the Gemini concept.
The Gemini project features a series of hub ports around the world that handle the bulk of the cargo. Containers are then immediately loaded onto smaller ships destined for spoke ports dotted all over the world. Central to the project in Rotterdam is APM, which bills itself as the most advanced, most fully automated terminal in the world. Its CEO is Harold Kunst.
The Gemini approach is different than the traditional shipping line approach we took for many decades. With the hub structure integrated into the network of the 5 hubs in the east-west approach from the trade, is that we are able to enable the ships to be 9 days earlier from Far East into Europe.
Ports like Rotterdam in Europe and Long Beach in California are seeing greater demand than ever for cargo handling and are investing and innovating to keep up with what's coming their way. So why is it that they still lag so far behind their counterparts in Asia, in the Middle East, and even in Latin America? Why is it that it takes 2 or 3 times as long to move a container at a U.S. port than it does in China? It turns out that there are several reasons. First and most basic is that 24/7 schedule that Cordero is pushing for at Long Beach, but that hasn't yet been accomplished.
After 9 months in the year 2024, because of expanded hours of operation, which commenced with the 24/7 conversation, again, Are we 24/7 today? No. Have we taken incremental steps to expand operation hours? Yes. That's a big reason why we don't have congestion and bottlenecks at the Port of Long Beach, because our terminals have been able to work with us in making sure that we use night gates, we use early morning gates, we use weekend hours in times that we have historic volume, which is what we have done. So I think, again, we'll get there.
Even if Long Beach were up and running all the time, it would be very difficult for it to approach the efficiency level of some major ports because of where it fits in the supply chain. Goods coming into Singapore or Oman, for example, are transferred from one ship to another, rather than being moved overland by train or truck for distribution in the United States.
We're not a transshipment port. I mean, some of the larger ports that you look at, for example, Singapore, they are a transshipment port. They always have been and they always will.
And finally, there is the question of automation, something that others make more use of than the US. But as much as automation promises to be an answer to so many prayers for greater efficiency, first, it comes with a price, quite literally, in the investment it requires, with the associated questions of where the capital will come from and whether it will earn the return on investment normally required.
There's about 1,200 legitimate container terminals throughout the world. Only about 4% are automated. So the challenge with any type of transformation of technology is a costly endeavor. So from a private sector perspective, what's the return on investment? I think that question is probably going to be more challenging moving forward, because obviously none of this happens unless there's private sector investment.
In the United States, it's not just a question of the capital investment and return. Automation also has potentially substantial effects on employment, which led 47,000 members of the Longshoremen's Union to go on a 3-day strike in U.S. ports on the eastern seaboard and Gulf Coast in October, something Cordero on the West Coast is very aware of.
For a port like Long Beach, who are public ports, we need to take into account the social impacts that has. I think that at the Port of Long Beach, we're proud about the footprint that we have in terms of job production. 535,000 at the local level. At the state level, 704,000 plus jobs directly and indirectly as a result of the Port of Long Beach. And at a national level, the number is like 2.6 million. So we're talking earlier about the great economy that we have, our dependency of our GDP based on consumer spending. Robots don't spend money, consumers do. So that's the conversation that I haven't really heard amplified, because for us, it's very important to keep labor in place. Because hypothetically, if you eliminate labor, what are you doing to the economy and spending in terms of consumer spending?
What's up? 2024, gonna be 2025. It's December 8th. Okay, so let me show you with the SMCI right now. So after hours on Friday, it was up around maybe 8%. It almost tried to hit $50 a share. So we got I don't know, I probably will end my trade here pretty soon. So tomorrow I'll see if it tries to get to 50 plus, and I'm done with it. Yeah, I'm just gonna try to get out. Here's the after overnight hours trading with Robinhood. So you can see, yeah, it's still trying to get to that 49 and hold it. So we'll see what happens pre-market and then into the opening. But once I get that, yeah, I'm gonna get out of my two positions there with SMCI and SMCX. SMCX being the 2X leverage ETF on that thing. If you have options on this thing, yeah, I've seen some screenshots of people having a ton of options on SMCI. They're probably up like 1,000% at this point. If they held it all the way from the really low levels on their calls. Yeah, it's up to you guys. For me, I want my money to be pushed into crypto in the next 2 weeks. I think this is the last big move in crypto for the next 2 weeks. We're gonna have all the miners probably gonna be popping Small caps will probably be popping. I'm looking more at the biotechs. So all those will be pretty important. Oh man, yeah. If you guys got a lot of swing trades, you want to get more aggressive, this is the time. If you're gonna do day trading, this is the time. That's it. And then we're done. We're done for the year. I think once we hit January, you'll see what's up. So yeah, don't expect January to be like a continuation of December and November. That's gonna be pretty hard. I think so. Yeah, that's right, HB. Robots don't spend money. What's up? Donkey Kongington. All right. So here's another video. I got 2 more videos here for the beginning part. I got TikTok banned. TikTok.
Let's get some more on TikTok here. Let's bring in Fast Money friend Gene Munster. He is managing partner at Deepwater Asset Management. Gene, great to see you.
Hello.
So, I know you were listening to the discussion very intently that we were having here on the desk. Meta has upside, but not necessarily any down. I mean, do you think that there could be any sort of retaliation on the part of China if a ban on TikTok goes through?
Absolutely. I'll add my kudos to Rebecca for pointing that out, too. I do believe that this is ultimately part of the chess match that's going on with the Trump administration, with where his relationships are growing, potentially with Zuckerberg, and what that means for TikTok. But to answer your question is that if this, in fact, does happen, if the U.S. does go and ban this, I think there's 2 paths. One is that China just basically folds, and it's a negotiating piece by saying they don't want to sell. I say China. China basically controls TikTok. It's a negotiating point. They say they don't want to sell. That negotiating piece is basically to scare lawmakers that their constituents would be disappointed if the app got banned. But at some point, if it's clear that they are going to get banned, they could fold and take the $100 billion and walk, the TikTok shareholders. But if not, it's going to come down to, if this does in fact get banned and they don't take the money, there's going to be some form of retaliation. The 2 obvious targets are Tesla and Apple.
In what way do you think the Chinese could exert, pressure on, I mean, Tesla, they could do whatever to their factories. In terms of Apple, what would be the way you would be concerned about retaliation?
So China is the master at red tape. And I spent 7 years, spent a lot of time in China, covering a lot of the China internet companies, worked with a lot of Chinese people. And I was taught just in terms of what they want to do things is below the fold. And so the master of red tape would be just making it difficult. How many hours a week they could change some laws about number of hours a week that potentially someone could work. They could change how much power a given Foxconn factory can use in a given week. They can work. They did this to Tesla. They can impact the trucking companies that would take the Teslas to port to be exported to Europe. They could do something like that with Apple. So I don't think it would be something where it'd be a big headline. The last piece that they could do is they could have a big influence in terms of how Chinese people think about Apple products or Tesla products. They obviously control like what Weibo and that language is, and they can influence that conversation. And so there's a lot of levers below the fold that can be used. Unfortunately for investors, it's not going to be an obvious headline. It's just going to be something where the gears of progress just slow.
So, Gene, is Apple mature enough and diverse enough now that, maybe 5 years ago this would have been huge for the stock, but in today's Apple world, it's not going to necessarily move. We're sitting here, it's at an all-time high, despite the fact that we're having this conversation.
So this is my biggest concern. I own Apple. Our firm owns Apple. I think that the stock is a big opportunity ahead of it relative to AI, but this is the biggest concern related to China. And to answer your question is that if we look at the total revenue from Apple, we estimate about 45% of that is somehow related to manufacturing in China. Now, as you said, that's been coming down, but it's still a relatively big piece. And what I described about that red tape, that slows things down. It doesn't take it to zero. It would be a slowing factor, and you'll know it. And lead times going up for products that are impacting the quarter. So I think investors are going to have some room to watch how these dials are progressing before any quarters reported.
All right, we got some war going on with China for that. Okay, going back here. Yeah, nothing much on the overnight for SMCI now that we see like 12 something%. So that's good. So if you got that, yeah, consider getting out tomorrow if you need the cash. It could go to 60 by the end of the year, but there's probably better trades out there with your money at this point. It's already been too good of a trade. All right, so let me see. Let's look at China and the shipping stuff. So the first video we had shipping. So if you remember, I drew this little thing here where I just made a bunch of labels on this chart. This is the Hong Kong Hang Seng Index futures. Well, one of the futures anyway. I just used the HK33 HKD proxy with Owanda in the trading view. So you can use that one if you want, or you can just use the HSI futures. Yeah, from Hang Seng. Now, you got this little Wyckoff thing, and I've been waiting for this whole thing to complete right now. So let me get rid of this. Now you see this is what I drew when they had that huge sharp spike on the first big bazooka of stimulus. Now I'm waiting for the second one. That'll probably come pretty soon. The Chinese will try to get ahead of Trump tariffs. They'll pump, and probably the next place to get in is when Trump gets inaugurated and he starts like putting more screws on the whole pressure pipe here, and then it's going to be like, yep, up and down, before the final release. And I don't know when that will be, but I think eventually, yeah, it'll be a tit for tat, shake, and maybe starting in the summer into second half of next year, we'll finally get a lot of breakouts on Chinese stocks. And that should coincide with a lot of weakness in U.S. stocks, because U.S. stocks at that point will be too overpriced. So people will just look at Chinese stocks as really underpriced, and then they'll just shift their money towards that if it looks like it's really easy to juice those stocks, and it should be. You already see a lot of that happening with something. Man, it's really slow. What's going on? All right, sorry about that, guys. Looks like the internet is getting a little whacked. I think we got hit by a solar flare or something. But anyway, okay, let me see if the internet's better now. Okay, see Kingsoft. Okay, looks like it's better. Let me see if the StreamYards isn't dead. Okay. All right. So Kingsoft, we got this nice chart. Very nice. We've broken out $7 here, 7.3. This thing has been defying gravity, yeah, since the first initial pump, and then it just kept going, totally ignoring anything with China. And it seems to be acting more like it's an AI software stock that has nothing to do with China. So the way it's moving, very good. You got nice volume coming in, and it's continuing every week. So last week was up 38%. Now, here's the last point of contention, around $10.30. Once we get this should be a completed base. You see this? This is a huge base from February 2022. Once this thing is done, yeah, we can start flying back to 70 or whatever end of next year. That's my guess. Yeah, we'll have to see how it goes. Okay, guys, we'll have to see how it goes. Okay, CKJ3 is like looking at Target, BIIB, Roku. Roku. Haven't looked at Roku in a while. Let's see what Roku. Yeah, I see it. Yeah, it's definitely making a base here too. I think that's probably common with a lot of these software type stocks. BIB, I haven't looked at that one, did I? Yeah, making new lows. Okay, I'll put it on my list to look at. Target, didn't it get hit on earnings? Yeah, I see. Okay, yeah, I'll put it on my list. I think Roku's probably the best one out of all of them. Yeah, we got a lot of charts to look at. Okay, I'll keep that in mind. Roku, Target, write it down. Target and BIB. Okay. All right. Now, okay, shipping. When we covered that video, that was a very nice documentary. Shipping. So, Zim. So I got into Zim around here, right? Yeah, here and here. So 18, 19, 20. And I sold some when it got into earnings and then pushed to 30. Now it's back to 20. So I'm going to wait for it to pass through 23 again. Then I'll add more back and show container shipping between China and the US. We'll see how this goes. This will be affected by Trump for sure, I think. But overall, shipping rates will continue to rise. Shipping rates are never coming down since COVID. It's over. So that's one inflationary piece of the puzzle that will keep on rising. So even though like fuel prices are going down, shipping container rates are still peaking up. Okay, I don't know when they'll actually peak, but I'm assuming that's going to coincide with when China's stimulus finally reboots their economy, because their economy is still trash. That's why oil is still low. Let's look at the around $67 a barrel for US. WTI and Brent is around 71. Yep. Yeah, we're still at these lows here. So there's no rush here. And if you want to look at something, look at gasoline. I'll talk about that sometime later in the week as we get closer to the midpoint of December. We'll see UNG. You can use that. And so you're going to look at the last stream. I talked a little bit about it. And natural gas pumped again today on weather reports. So it keeps trying to edge up here. Natural gas. But yeah, I'm looking for another chance to short it. So I shorted it twice, like here and then here 2 weeks ago, like around Thanksgiving, right? Yeah, Thanksgiving, sometime around there. And then, yeah, I'm waiting to see if it finally collapses. And then that's it. Natural gas will just trend down. But, it could just go sideways and keep going that way. That's also possible, which is very bullish for the spring. So the next time to get long into natural gas will be the spring. Thinking they might have got bought. They might get bought. Yeah, I don't know nothing about that. Yeah, I don't look at fundamentals at all, so I don't know. But the chart looks good. Not sure if they're gonna get bought. I mean, Intel was supposed to get bought, but that didn't happen. Their CEO got kicked out and all that other stuff. So I don't know. Rumors are rumors. We can't do nothing about them. So unless there's something hidden, yeah, I'm just gonna assume it's just following the rest of the software / internet communications complex here. Man, wasn't there some other stock? There was another stock that got wrapped in with Roku. I forgot. That was way back when, in the 2021 COVID times. Yeah, people were just trading Roku and some other one. I forgot. They were similar, same area. Okay, is this UNG? UNG is this thing. UNG is the gasoline. This thing. Yeah, UNG. So that's gas. This follows the RBOB. RBOB is gasoline futures. So if you can just trade futures, you already have access to futures. Just trade gasoline futures. Like CKJ3 doesn't need to use UNG. You can just go ahead and use RB. Okay, so RB, that's the RBOB gasoline futures, and you can talk to Master Kim. Master Kim actually has to deal with this shit. And then he mentioned something else too. I forgot. another futures product with diesel. Ah, man, I forgot what it was. Okay, I can't look at it now. Maybe I'll play a video and I can look it up while we play that. Let's see. Okay, put that back up here. So yeah, China, I covered that. I covered a ZIM, ZIM, okay, for shipping. We'll see if I buy back and then get back to 30 and then try to break out into first quarter next year. But yeah, I think the focus right now for me is going to be like ARK, like Kathy Wood shit, ARK, ARKK, and you can use the leverage ETF TARK for the 2X. So it's going to break out here. Yeah, I think so. Yeah, it definitely looks like it's going to break out. Yeah. It's about to break out here, the 60 level. Yeah. And then you have the ARKG, which is like at the bottom. So it's the worst of the biotechs. So these are genetic companies. And then you can look at the ARKG and all that stuff itself and then find out all the companies in the trash line. Look at no. CKJ3, not the NG futures. It's trash to trade right now. Well, unless you're talking about like natural gas, but we're talking about like the gasoline. So RBOB gasoline, but natural gas, no, it's always hard to trade that one. That's why I just go boil and coal when I see a trend forming, because I think natural gas should go down. Usually seasonally, that's what happens. Everything is seasonal. So gasoline does well mid-December to January, like maybe first week, second week of January, and then yeah, natural gas tends to drop in the winter, starting from into Christmas and then down into spring and then later. So that's all it is. What's the name of the futures? RBOB. RBOB. RBOB gasoline futures. So you do exclamation point RB. Yeah. And then there's tons of other ones too. Like you see this crack spread, you can talk to Master Kim. I don't know any of that stuff. RBOB gasoline versus New York Harbor ULSD futures, Brent crack spread. Yeah. There's tons of this stuff. So I'll have to look up the diesel one. Diesel, they use heating oil. That's the heating oil, but they have another futures for it. Okay, let's play this one here for Palantir, my favorite stock.
Major tool for Musk and Ramaswamy's government efficiency agency could be artificial intelligence, and Palantir is already in the game. Anthropic and Palantir announced last month that they're partnering with Amazon Web Services to make Anthropic's Claude models available to U.S. intelligence and defense agencies. The agencies aim to use the large language model to process vast amounts of complex data rapidly and streamline clerical tasks for the government agencies. And when you say streamline, doesn't that mean saving money? That's not the only positive news for Palantir in the past couple of months. The big data tech company joined the S&P 500 on September 23rd and has been on a roaring rally since then, gaining 93%. Joining me now on a Fox Business exclusive is the man leading it all, Palantir CEO Alex Karp. I got to ask you about the stock. It has been such a wild ride. You joined the S&P in September, but even before that, people who understood the business jumped in and said, we believe in it. I mean, that's got to feel really, really good. Almost, I guess, a little bit like the world has woken up to something you already knew. And quite frankly, we already knew because you've been coming for about 3 years.
Well, you seem to know it early. One of the few people who invited me on when I was a pariah, which was about 18 years of our 20-year existence. Yeah, look, things are good at Palantir. We said that, the world is moving to software first, which no one believed. We said the way to build products is the way we did it, which no one believed. We said that you had to go back to what's now called kind of first principles, what an enterprise should do, not what an enterprise thinks it should do. We believed in meritocracy and hiring the best people. We believe America's a great country and our enemies should suffer. And we built products around those ideas. And, you know, there are a lot of people who didn't believe, some who did, and those that did were well rewarded. And we're kind of nose to the grindstone now. We're, you know, very focused on the U.S. U.S. is doing very, very well for us, and I think in general. And it's a good time. It's a great time at Palantir, and maybe not so great for our doubters. You know, people who didn't want to listen to proclamations of obvious truth, like, you know, an enterprise should work.
Yeah.
This nation is great. We have the best people and have the best products, and we built these products that are basically were built years before people thought we were relevant. The most relevant one of now is how do you manage large language models and AI so that you can actually extract value, and the value is quantifiable either on the battlefield to bring soldiers home, kill our enemies, or in commercial to change margins, reduce dwell time, reinvent your business. And one last point. One of the most important things people do not understand about AI is they understand roughly kind of how it could work. Of course, they also have noticed that many AI companies are, you know, the large language models alone basically lead to a science project. But what the purpose of what you can do with AI is you can do exactly what we did at Palantir, which is build your institution the way it ought to be built. A country ought to have a border. A military ought to be efficient in both how it spends and how it kills and how it protects. An enterprise that's in manufacturing should be able to control the supply chain, should be able to control the workforce, should be able to manage people who are smart but not technical but maybe don't have business acumen. Those kind of things can be managed. Bringing an institution back to what it ought to be is the single purpose of what Palantir does, and we're now able to do it, which is why our enterprise business in the U.S. is just rocking. Very, very rocking.
I mean, it's unbelievable. Total commercial sales in the third quarter rose 27% to $317 million.
Well, the most important stat for me.
Are you trending the same or even better this quarter?
Well, obviously, I can't talk about.
Yes, you
can. Well, unless you want me walking out of here in shackles, I'm already pushing the limits. But. Yeah, no, I mean, look, our U.S. business grew 44% last quarter, 44%, with a latent, basic, non-existent sales force, with me as a front man offending half of America, or actually the other half loves us. I mean, the people that like believe in truth and justice and meritocracy and having a border, but sticking to our guns. And we've stuck to our guns, and the most important part of our business, that's commercial and government, is growing at a very. And then there's this, for people who aren't in business, there's a rule that's basically like a diagnostic of health, and it's called the Rule of 40. And that Rule of 40, I think we have the highest in the world, 68, which means while you're sitting there, one of the biggest trends that we've had to fight against is the experts are only experts in this country at being wrong. Their expertise is, I'm wrong. And they're not even consistently wrong. And so when it comes to Palantir, it's like, oh, they're a services company. Oh, of course you have to build software so that it is a parasitic entity on an enterprise instead of that it actually is aligned with the enterprise. And, you know, so that we are, the actual results force those experts to say, what the F is going on here? It's like I can see their teeth being spat out against the window.
Well, isn't that what Elon and Vivek Ramaswamy are doing right now? They're looking at government spending, government inefficiency. I mean, you just talked about making commercial operations more efficient, government operations more efficient. Have you talked to Elon Musk or Vivek about Palantir?
Without going into all, Palantir, we want to support the U.S. government. We want to support them. I completely support the mission. And and again, there's two parts of the mission. Getting out waste, figuring out what works, investing in what works. But there's also, we have a dearth of legitimacy in this culture. Almost all our institutions that are in charge of measuring, fixing, doing things have low legitimacy. Whether they deserve it or not, no one believes when the ICC says something. We believe they're anti-Semitic. We believe that the doctor is politicized. We believe our universities aren't teaching anything valuable. We don't trust that, and neither side trusts. And the idea that like blue is right or whatever, no one believes it anymore. So we need transparency as the first step to reinvigorating legitimacy in this culture. And I wholeheartedly support what they're doing, and God knows, you could not have a better person than Elon doing it.
What if they come to you and they say, all those programs that you're doing for the Defense Department, we're cutting back the Defense Department?
Okay. Well, you said all those things you're doing. Like, I have enormous faith in both of them to figure out what's working. And Palantir exists to serve this nation. And I mean, we need to know what's working and what's not. And I think that's great for the nation and probably pretty good for Palantir too. You know, software, especially software that's productized, is enormously efficient. The underlying economics of software is both sides get more. I build a product no one else can build. I sell it to you at a fraction of the cost of building it. I'm happy because I can sell that product everywhere. You're happy because you could never build that. And honestly, if you had $1 billion, you couldn't build it, but you might think you're going to get $1 billion and build it. And of course, that doesn't work. Efficiency will not only make everything cheaper. Transparency will not only be cheaper. It will be, the output will be better. And again, the primary basis of the U.S. economy right now is tech. The primary lesson of tech is you get the right people and you spend less. And you get massive output. And so, like, all these things that are likely to happen by looking at transparency they're going to lead to increases in transparency. And by the way, increases in lethality.
The AI piece of all of this has enhanced so much. Certainly the work that you have helped the Ukrainians do and the Israelis do on the battlefield. But in the past, you guys have been very clear. It's on your website that you say, we believe in augmenting human intelligence, not replacing it. But considering how far AI has come in just a short time, do you think that it deserves a little more latitude beyond the
Well, there's a
humans?
lot of super interesting questions, like, for example, on the battlefield now, peer-to-peer adversaries. If you're defending against their missiles, you're going to not have time to go back to the human. But there's ways in which you can use software to code ethics into the program so that you get the data feed comes in from large language models and other AI systems. The large language models are not precise enough, and the other systems may be precise, but they're not ethical. And you can have the decision feed into the software, and the ethics, human ethics, can be encoded. But yeah, we're entering a completely different world. And part of the reason we're entering a completely different world is we have pretty lethal and very competent adversaries.
Is it too early to ask if you guys have considered AI-driven peacekeeping or conflict resolution software?
The primary way to create peace in this world is to scare our adversaries when they wake up, when they go to bed, while they're seeing their mistress. Whatever they're doing, they're scared. If you want to have peace in the world, that's how you do it. And that is our peace-giving offering this Christmas season to our adversaries. We are going to help this government be more transparent, work with Partnership in America, and our goal is everyone who does not like America, does not like what we stand for, does not like the West, thinks we're useful idiots, is going to be scared and uncomfortable more tomorrow than today.
Well, that is a nice big bow around a Christmas gift.
That is our Christmas present. Happy Merry Seasons, whatever you celebrate. Please, and to all supporters of Palantir, Merry Christmas and a Happy New Year's. And to all people who've hated on us, enjoy your coal.
Oh, God. Alex, never a dull moment with you. Thank you very much for joining us.
Thank you.
Don't get up.
Oh, sorry.
You hated it so much, you're going to run up.
Yeah, Merry Christmas, Happy Kwanzaa, Happy Hanukkah. Hanukkah is actually on Christmas Day, the first day of Hanukkah, I think. Should be Christmas. Very interesting. Very interesting. So we're going to have a very fun time, I think. Very bullish on Skynet and all the associated dystopic technologies that will come from fruition in these times. So I looked up. So diesel, you'll use the New York Harbor ULSD futures. HO. Ho, right there. So yeah, there's a lot of futures out there, in the futures world. I never bother looking at them, but everything's tradable in the world. You can trade anything you want. And if you have access to Chinese futures, even better. You can trade their coal futures and their I think they have other futures too that they introduced as well. Platinum, yeah, they have a new platinum futures that's going to be online or already online. I forgot. Oh, okay. Let's look at Bitcoin right now. So it tried futures open. Bitcoin tried to get back to that resistance level, but came crashing right back there. So we're still stuck. We're still stuck below the 100 and 1,300 area for resistance. Once it breaks that, we can go back to 103, 400, 300, 400, and then move on from there. I think by the end of the week, we should try to make an attempt at 112, 115. That'll be the first stop. Then after that, probably pull back again into options expiration for the whole stock market, into Jerome Powell, see what Jerome Powell says on Wednesday next week. So that's 18th, December 18th, Jerome Powell's talk. And then from there, we'll see how it goes into Christmas and New Year's. And that, I believe, will be the last blow off top for Bitcoin, trying to achieve 130, 140,000. And then from there, it will pull back. That's probably where you're going to start shorting Bitcoin. And then you'll watch what the altcoins are doing. If the altcoins hold up and Bitcoin doesn't fall too dramatically and goes down in an orderly fashion, unlikely, but maybe, then you'll have a long altcoin season into the first quarter. And then from there, wait for April, so around tax season, and then Bitcoin will try to rise again into May and June. That's what I see from the cycle analysis so far, but that may change, right? So keep watching this channel for updates on what I think. But for now, yeah, aim for 110 to 115,000 Bitcoin this week, and then break for the Jerome Powell on the December 18th, and then Christmas, New Year's pump to 130, 140, and that'll be the end of it. That'll be the first phase. And then the final phase will be the bigger move on Bitcoin, maybe to 200,000 in the summer. And then after that, we're done. We're done for this cycle. You got to wait another 4 years, and then we repeat it again, and we do it again. Okay? All right. Okay. Anything else for that? I have a whole bunch of stocks to talk about. The charts, go through the whole list of them. Yeah, I have the list right here. And I added some in the banner. You can see it scrolling. There are a bunch I added. I'm adding the space stocks. Those I'm going to watch because PL will have earnings. There's a lot of earnings coming up. Also have to talk about those earning stocks and also cover some of the earning stocks from the previous week. I saw a lot of interesting looking charts for retail stocks like Dollar Tree, Dollar General. Those will be good to try to look into, get a nice dip into, and then from there we can go on talk about AI stocks. Okay. All right, so I got to play a few more videos here. This one is semiconductors. So this Global Foundries, symbol GFS. Okay, so.
Defense Forum. She's joined by Global Foundries CEO Thomas Caulfield. Welcome to you both. Morgan?
Kelly, thank you so much. And Tom, it's great to be sitting here with you. Kelly just talked about defense stocks, but semiconductors, key part of the national security conversation, and it really speaks to this intersection, this growing intersection that we're seeing between technology, industrial policy, and supply chain and national security.
Absolutely. You think about how critical technology, in particular semiconductors, are to supply chain security, economic security, and the intersection with national security. And I think that all comes together in a conference like this.
You just recently got the direct funding, the $1.5 billion from the CHIPS Act. So how do you put that to work now, and what does that reflect in terms of this broader conversation?
Yeah, so a little context. The CHIPS funding is a part of the government co-investment with industry to bring semiconductor manufacturing back into the U.S. Remember, there's the investment tax credit that's a big part of that program too, that dollars come in. Look, for GF, it's about expanding our manufacturing footprint in the U.S., the CHIPS bill. The first part of it is to bring a broader set of technologies into our existing facility in upstate New York and modernizing our 200 millimeter facility in Vermont. And then as the demand in our industry really starts to pick up again in the auto industry and the smart mobile device industry, we'll then add new factory floor space and create more capacity there. So this is a journey, not something that ends and begins in 2025 and ends in 2025. This is a 3 to 5 year program.
Do you think the U.S. can really, truly do this, stand up a homegrown,
vertically integrated supply chain for chips manufacturing here. And I ask that knowing that the foundry business at Intel, for example, has been one of those challenges, and that's a company that's been going through its own strife.
Yeah, I think the United States can, and the government can. What's important is this can't be a start and stop. Our industry is 50 to 60 years old, so it's relatively new industry. It just didn't happen overnight where we have a high geographic concentration of semiconductor manufacturing. That's not in the U.S. And this is going to take a decade to correct it. But the key is to start, make steps, but not, one day it's in fashion, the next day it's not. And I think it's important that through administrations that this continues because it is a priority for our nation.
Is that what you're expecting with the incoming Trump administration, that this type of policy, CHIPS Act, and maybe a 2.0, that's where we go from here?
Yeah, I'm absolutely confident in it. And I could say that because the CHIPS bill that we look at today really started in President Trump's first administration with Commerce Secretary Wilbur Ross, Treasury Secretary Mnuchin. They all started this. And as it built momentum, administrations changed. It got called different things, but it was a program that started before 2020, and here we are today. So I think it transcends all of this because it's back to what you started. National security, economic security, and supply chain security. We need domestic capability here.
Geopolitical landscape has been very, very tense. You have operations here in the U.S., but all over the world. Not in Taiwan or China, though. And I wonder that diversification away from those key hubs has actually meant that you've been fielding more incoming business.
The answer is yes. I think it's becoming more and more important. We talk about the geopolitical risk. There's also geological risk of having such a high concentration of this important capability in Taiwan. Mother Nature could create a problem for us. So any single points of failure in any business are problematic. And so one of the things about GF is we're in Singapore, the United States, and Europe, and very broad geographic footprint. It takes single points of risk out of view. Many of our technologies we can source from 1 to 3 of the different continents I talked about. And I think it's becoming more and more of a requirement for our industry to make sure there's better resiliency and less concentration.
And finally, just a macro question for you. What are you seeing across the business right now? We know that there's been continued to be softness in industrial and auto, but you look at ISM manufacturing this week, that seems to be trending in the right direction. I find myself having more conversations about maybe, at least here in the U.S., an inflection in terms of the industrial part of the economy. Are you starting to see that? And I guess how do you balance that against the rest of the portfolio tied to AI and things of that nature?
Yeah, look, this has been a really long cycle other than the AI boom in the data center. It's been a long cycle for industry in a little bit of the doldrums, the low end of things. We are seeing things pick up, and it's because of the content that's required. Automobiles, the units sold per year don't have to go up for our industry to grow because the more and more silicon content. It's a growth engine for GF because of a lot of the focused development and technology we've brought to the marketplace to serve the auto industry. So not only cars are using more silicon content, GF's won more sockets and more applications in the car. So it's one of the things we're seeing is propelling our business. The industrial IoT, I think, has a little ways to go. It's still a little bit soft. But what will happen is as companies use more and more of AI, they're going to need to refresh that capability, and it's going to start in the industrial space.
Co has the action. Hey, Mike.
Yeah, so Oracle and Adobe, both of those are implying big moves, about 8%, both traded above average daily options volume today. Broadcom implying a move of about 6%, and it traded more than 3 times its average daily options volume today. We saw calls outpacing puts in Broadcom by more than 3 to 1, and the busiest contract was the December 180 calls. We saw over 10,000 of those trading for just under $7 a contract. So traders there are obviously betting that the rally that we saw today could continue following earnings.
All right, that is the big earnings for this week. I think it's Thursday after the close. Broadcom, AVGO, that's the one. And once that's set, there's only one more semiconductor earnings left, is MU. I mean, last week's Marvell, MRVL earnings was very interesting. I think a lot of custom chips were mentioned. for AI that they're developing, and it's really ramping up for Amazon. So they're going to start eating away at NVIDIA's pie. Okay. So people that are using GPUs and that ecosystem, yeah, there's alternatives if they want to do custom. So I think, Meta, I think we're trying to do their own as well. I'm not sure if that got anywhere. So I'm sure Google, they all have these black projects where they're working on their own chips and try to, get away from NVIDIA. Because NVIDIA itself is going to be inefficient because the GPU is like, it's programmable, right? In a lot of senses, it's not fully programmable like a CPU, but it's a lot more programmable than a FPGA or whatever. So I'm throwing out a lot of jargon right now, so you probably don't understand all these acronyms. I should, because I did come from the semiconductor industry, I should continue talking about it because one of those late night streams, early morning streams on the 24-hour, I started talking about semiconductors a bit in detail, going over a report on the semiconductor supply chain. I might just make that into a new series of videos where I just start talking about like industry specific things. But of course, I'm out of the loop. I haven't worked since maybe this 16 to 24 nanometer node. Nowadays they're at 7 nanometer and whatever smaller size transistors, and I'm out of loop. Things advance very quickly in technology. Okay, now I'm gonna go play this video. Joe Rabel. So this is gonna be a little summary, okay, of the market conditions. I think he does a very good job, and the game plan, which we are going to have to do into January. So prepare yourselves, right? So definitely always think 2-3 steps ahead of what the market's doing.
Hi, this is Joe Rabel with Rabel Stock Research. So today's lesson is basically a prep for next year. I think what we're seeing right now looks like we want to finish the year on an up note, or at least not give back a whole lot. And then I want to talk about what I think could take place next year and the reasons why I'm thinking that way. All right, so let's go ahead and get going with this. Okay, so I've got the S&P chart up, and I'm using a yearly bar chart. All right. Now, I have brought these up in the past, but I want to go into a little bit more detail in the way that I'm looking at this, and especially now based on where we are during the time of the year. All right. So we've got a yearly bar, meaning we're looking at an open, high, low, close candlestick that is based on the year. All right. For 2024, we opened up basically down here. We had a little bit of a check back, not much of a move to the downside, and have basically been moving up, straight up all year. A few setbacks, not a whole lot of pullback. And now, with not that many trading days left in the year, if you go and look at your calendar, look at the holidays involved, there's just not that many days in here. And so I think the likelihood is, even if we have a little pullback, that we probably finish off the year somewhere near this area. I would say at least in the 6,000 zone, I guess, is where I would be expecting. All right. Now, it's possible to actually do better than that, but there's a few things that are glaring when I look at this yearly bar. All right. So first of all, we want to pay attention to the 4. This is the 4MA here. And we want to look at periods where we get stretched away in either direction, one way or another. All right. So if we start to get too far away one way, we sort of look for it to check back. If we come down too far, we expect it to sort of snap back towards this line. And you can see whenever we do that, we get these little pullbacks. And we had in 2021, we actually got too far away, and then we ended up having a bear market, right? And then it returned back to the line, found support in the area of the line, and then has turned back to the upside. But look at how far away we are now. Now, you think about it, we're so far into the year. Typically, when you open near the low and you're near the high this late in the calendar period, we sort of expect it to finish off on an up note and finish as a big green bar. And then we look for follow through into the new year. I think it's possible we'll go to another new high as we go into the new year. But if you notice, we're pretty far away from this 4. All right. So there's risk of some kind of a check back. Now, it might only be to the midpoint of this bar where it meets up to it, but there's some room in here for this to back and fill. Could spend the first 6 months backing and filling. It could pull a reversal pattern, but I'm not really looking for that necessarily. One thing that is bothering me a little bit is that we've gotten pretty stretched away, kind of like we saw in the late 90s. You see how far away we are from the 18-year moving average, okay? Doesn't happen all that often when we get that far away. The other thing that's bothering me and that is glaring is that this is the biggest bar on the chart, all right? So we make a big move and we get stretched away from the 18 and we create a monster green bar. All right. So when we get a monster green bar stretched away from the 18, we should be thinking there's some risk. Now, am I really calling for this to come back to the 18-year moving average? Not really. No, I'm not. I'm not looking at that. I think the momentum is way too strong across multiple timeframes for the most part. But we could have some risk when you look at the weekly chart and the fact that it's not confirming. We have some risk for this to spend some time consolidating or pulling back. So I think we need to be aware of that. If we go and look at the way this played out in 99 into 2000, we were up, and then we opened up in 2000, made a push, and then came back down. This is the signal I'd be on the lookout for. So let's say this is this year's close. If we open and we make a push to new highs, we're looking for the point where we come back down through last year's high and last year's close, and preferably the close, get back down through that and turn negative for the year. All right. So if we make a small push to the upside and have a reversal, basically like an opening reversal type pattern, when we push up and come back down through the close of last year and the open of this year, then I think there's some risk in this market. All right. Now, actually, let me leave it on this, and I want to show you one other thing. So we can switch this to now. One of the things I wanted to point out that ACP I really like is just giving us the ability to look at these longer term timeframes like this. Not all software programs are going to offer this, but what I like to do is look at the 18 core line. You see how great a line this is for long term investors. So we do break it. We can consolidate and come down to the yearly line periodically, but the reality is that this line, when we come down to it, tends to be a really solid support zone. But when you get stretched away, it's also a sign of risk. So we want to be aware when we're getting too far away from this line, especially as we're flipping over into a new calendar year. All right. So we're finishing off the year, finish off this quarter. If we get a little follow through, we see red early, meaning we go to a new high, and then we see a move back through the open of the year, the new year, and the close of last year. I think the risk of this starting to correct, come back, maybe even working its way back a little bit closer to 5,000 or something like that, you definitely feel it in your stocks. You want to be aware of where the market is at this point. And the reason is that we've got a few things. Number one, the sentiment has gotten a little too bullish right now. And I don't view that as a timing tool. I view it as a condition. And all the stuff I'm talking about today are conditions. They're not timing tools. We're just saying we're stretched away on these long-term charts. We've got a momentum. We have momentum that is not confirming on the weekly ADX. All right. And this is not that different than what we saw late in 2021, where we pushed to new highs. And then what ended up happening here is the volatility dramatically increased. All right. And we got too high volatility, no momentum confirmation. Well, we're in the same boat right now. Now the volatility, because we've had some smaller bars here on the weekly, the volatility is starting to drop a little bit. But right now it's still too high. And if we have that and we don't have confirmation, we finish off the year that way, then again, I think there's some risk of some follow through and then corrective action. So you want to be aware, just be prepared. Always want to think 2 or 3 steps ahead like a chess player. Don't just come in not recognizing how we're situated. And I think you're going to be in a much better position come the new year. If you're enjoying the content,
All right. So that was a good summary of what we got to expect. Okay. So be prepared. I'm not like, I think, yeah, you should never be like one to be called in tops and whatever, but it is the new year. So look at stocks that are going towards their bottoms. You look at stocks that are going towards their tops, and you look at stocks that are about to break out. There's other ones like Honeywell, was that one of them? Yeah, I forget. It was a Deere, the tractor company, right? So they also have like breakout. So you look at all types of charts and see how they move and how they behave, and then look at like the S&P 500, the Dow Jones, the Russell 2000, all that, the NYSE composite, whatever indexes you want to use, and then you say, okay, these are the individual stocks I look at. They give me a barometer. They give me a sense of where the weather is going to be, where the wind's blowing, the humidity, all that stuff. So it's like, that's all you can do. You can't exactly predict weather, right? But you can figure out if a hurricane's going to come pretty quickly once you see like certain signs. You're going to see dark clouds, the humidity is rising, the air pressure is changing, stuff like that. That's all it is. That's all that we're doing right now, is when we look at charts, we are trying to gauge conditions. We cannot predict the future. I never say I can just like, oh, I predict this, but I'll put out some targets. I'll put out some potentials that I think likely will happen just because of my experience, right, of what I see. And yeah, when you get better at reading charts, it just becomes second nature. It's really easy just to figure these things out. Okay, so we got to get to the charts. We got to go through a whole list of charts here. I covered Zim, I think. Bitcoin right now is at 99,100. NASDAQ futures, let's see, is it doing anything? No, it's still going sideways. Nothing exciting there. Hong Kong, okay, it tried to pump, but it's pulling back. So no decision on Chinese stocks right now either. So we're just hanging around on top of support at 19,600 on the Hang Seng index. So nothing there. Now let's just look at the charts. Okay, so we got to go through individual charts right now. So let me share the screen and we can go look at them. So I have a whole huge list to get through. See, Hong Kong right here is not doing anything. It just pumped, and then while we were playing those videos and I was talking, it just dumped. So no, nothing. Okay. Oh, this is GFS. It was the CEO that was talking 2-3 videos ago. Not a very good company, honestly. And it just had a recent IPO in October 2021. I don't see nothing interesting. Maybe I'll change my mind sometime down the line, but at this point, no. It's better. But it's better you probably stick with new coming. Marvell. What's the other one? A Lab. I think it was A Lab was on one. Well, yeah. So it had earnings. Marvell looks like it's gonna break out right here. So yeah, this looks good. A lot of my friends work in this dang company. Yeah, they have a lot of talent right now. After building probably over many years of acquiring different smaller companies. Yeah, that's a breakout. Yeah, that's a breakout. Yeah, Marvell's doing real nice. Yeah, probably better than Nvidia. Gonna be next year. Nvidia probably won't do much into next year. Probably a little bit, make a little new minor high, but that's about it for Nvidia. So maybe, yeah, Marvell will be the one that will take over the role for a little while. But I wouldn't be too invested in semiconductors right now. I think it'll. Man, see, I drew so many dang lines. Because this whole sector was so important this year. This is the whole reason for the first half of this year, from second half of last quarter. Yeah, most of last year too. Yeah, it's been driving. It hasn't been driving anymore, right? Now we're going to software. So that's why if we're gonna start talking about stocks, let's start talking about AI. AI will have earnings. Let's see, Monday after the close. So tomorrow after the close, might be breaking out. AI. So the ticker symbol AI, C3.ai is the name of the company. Yes, so I'm in this one. Hopefully this will break out. So then it will follow with sound. Sound was up like 63%. You remember I was talking about that last time this week. So yeah, all these stocks looking very nice, very nice. Probably by the time it gets to 17 or something, I'm out of here. I mean, it could still go up. I'm pretty sure, but I'm probably safer if I move my money to something else. We'll look at the crypto ones right now. Yeah, let's look at the crypto ones. So I was talking about Mara, right? Mara is in a range. So I played Mara last year. This is where I got most of my gains, was from Mara and CLSK when it was around October last year and going into January. Yeah, this one was really good. CLSK, same thing, $3 to $20. Yeah, that's excellent. Let's say, yeah, $3 to $4, right? Yeah, $3.50 around average. Yeah, this is perfect. This is a perfect play. I don't know if it's gonna repeat it this time though. It's hard to say, but hopefully once Bitcoin really guns for 130, 140 into New Year's, if it does that, of course. I'm not gonna say it will do that, but if it does that, yeah, this thing will shoot. The setup is really good right now. And if you want to look at other ones, is Wolf. Wolf here, WULF. HUT, HUT. Yeah, very nice. Nice basing structure here, about to break out. And my new favorite one, BTDR. And the reason why is because of earnings last week. Like the way it moved in earnings really looked very good. So this is the new contender in the Bitcoin mining space. Like you see here, look at this. Look at this. So this hourly chart right here, 65 minutes. You see during that day, during the first hour of open, so after they got earnings in the morning, you see, terrible reaction at the beginning. And then whoop, it just jumps right back up. So it hits this old level here around $8.70, comes right back up and then holds it. So it holds it for the next several days going into Thanksgiving, right? And then Black Friday, pump. Then this week, pump, pump, pump. Every morning, it's pumping, right? And it's like, bro, so once you saw that on earnings, it's holding that level. And then this range here from $7.50 or whatever, like that area, $8 into 12. That's it. Once it broke 12, it's going, because we're now going to new highs every day, new highs. And all we got to wait for is Bitcoin to really move. And I bet you this thing is just going to explode just for no reason, just because it's just easy to move it, right? You see it has very little volume, probably very little shares outstanding, floating. And then it would just be too convenient for somebody to just come in and just push this up. So this week is 60 million shares traded. So every week since then, it was like 40 million, 44 million, 30 million. Now we got 60 million. It wouldn't take much. It wouldn't take much at all for this thing to squeeze like crazy. That's no problem. Now the other one, CORZ. This one is not purely mining, okay? This one does like data center stuff, whatever. So it's just nice to look at and potentially make a play for. But it can follow Bitcoin. It might not follow it more exactly. MSTR, you know how this thing works. Michael Saylor's little thing where he just buys Bitcoin issuing stocks and bonds, right? And so it's a convenient toy to play too, because you got this nice leverage, and there's probably a lot of activity in the options market, I'm sure, for MSTR. And Mara is probably the biggest Bitcoin player with a lot of options contracts with a huge open interest and all that. But MSTR, you get the option of using MSTX. Okay, yeah, I gotta mention, people, stop using MSTU, because I've noticed several days for like at least two of those trading days, I noticed that it was not performing correctly. Like it wouldn't move up as high as it should, because theoretically it should match 2 times the percentage move of MSTR. But for 2 days, when it went down a lot lower than 2x, and when it went up, it didn't move as much as like 1.5x. And so when it went down, it was more like 3x. Like it was doing something funny. So I'm not using MSTU anymore. If you're going to trade it, use on the long side, use MSTX. And if you're shorting, you can use MSTZ or SMST. You can use either one. Yeah, I just mention it because MSTZ is like kind of a penny stock because it's below $1. So some people's brokerages might not be too restrictive. Yeah, I noticed that, like, I got to make sure that, some of you guys might have brokerages that might not allow trading of certain tickers. So if I give you an alternative to short MSTR, you can use SMST instead of MSTZ. So make sure you know that. MSTZ, 2x bear, SMST, also 2x bear, MSTR. Now the other one was IREN, IREN. This one is kind of like Core Z too. It does a lot of Bitcoin mining though, and yeah, maybe I might recommend it later on this week. I mean, it really depends. I got to see better things. I mean, I know HB likes to use Riot and whatever, but yeah, Riot is kind of like similar to Mara. So I don't like recommending 2 stocks that do the same thing. It's just not worth it. Like, I don't think Riot will just outperform Mara consistently, or Mara outperforms Riot consistently. You rather be in HUT or BTDR. So if you're going to spread your money around with different places to bet, yeah, don't just like waste your capital putting it in too many of the same things. So if you use Riot, then don't use Mara. If you use Mara, don't use Riot, okay? And yeah, otherwise, yes, just put it in the other things because they all have different characteristics. And right now, BTDR has been the winner. And I mentioned that maybe 5 streams ago. I started mentioning because once I noticed that, it's ready to go. Okay, let's look at what's on my list here to talk about. GameStop. That's going to be one to talk about. GameStop. Okay, yeah, it had its little pump on Roaring Kitties. Yeah, Roaring Kitty, Roaring Pussy, whatever the heck he wants to call it. Yeah, it had a pump here. Now, I don't know what's going to happen in earnings. I hate that this thing did not just pump way earlier, but it looks like I got to wait through Tuesday after the close. And then even then, I got to hold it into Wednesday. And then Wednesday, we have CPI in the morning, So that's kind of sucks. So this is going to require me to really, really assume that this time is going to be different, because usually GameStop earnings, the stock will just crap out right after. But if this thing is a big surprise up and it squeezes, and then in the morning, 8:30 Eastern, Wednesday morning, you get inflation report and it juices up the whole stock market even more, then GameStop it should not be hard to go to 60 from here. It shouldn't be hard for GameStop. Yeah, there's enough juice here to do it. All right, I talked about sound already, but let me do it again. So this is SoundCloud, or not SoundCloud, it's SoundHound, whatever the heck it is. And they had news about a taco stand. I talked about this last stream. Very weird. I have no idea why taco stands with getting a contract to use voice recognition would make this pump 60-something% in a week, but it did. We've broken out of the area of $9. We're now going to 15. Probably I'm going to jump out at 17 to 18 or something. I'll get out, but who knows? If the momentum is really good, maybe I'll keep some leftovers for CPI and it should work out. And the other one is AI. We talked about that a bit. AI C3 or whatever it's called, C3 AI. Yeah. Watch this. We're at 40. We're above this level. We're in this range. Yeah. Get ready. If earnings on Monday after the close, if this thing breaks out to 50, Then the next couple days after, assuming CPI does well too, then the rest of the week the stock market keeps moving up. Easy. This thing will go from 40 to 60, another 50% right there, no problem. And see, KC, yeah, I talked about KC too. KC, that the Chinese stock that defies gravity, yes. I don't know. I don't have much in this one. I really don't trust it, honestly. I mean, it is a Chinese stock. I mean, but the chart is telling me good things. So if it breaks 10, yeah, we're going flying. So maybe I'll decide to add sometime down the road, but not now. I don't feel like it. It's too risky. Okay, NVTS. I think we're getting some resistance finally. So this thing has been moving since $1.80 to $4. This thing does gallium nitride semiconductors for EVs and all this stuff. It's been beaten up since the announcement that Tesla wasn't going to use many of these semiconductors. You see, so it used to be in the November 2021 era, it was around $20. And then this was all due to the bear market. It tried to recover, and then Tesla comes out and says, like, nah, we don't need this shit. And I think when that happened around March of this year, or maybe it was last year, yeah, April, I don't know. It's been down ever since. So what used to be a 20-something dollar stock, now it's like it went down to $1.80. And guess what? It's in a bad position going into the new year. So I think this is going to turn around. So I'll be watching this. But again, it's semiconductor. This might be a little bit too late for it to recover, but you never know. Maybe this will not follow the rest of semiconductors, because I don't think there's much room for semiconductors to move up again. Maybe only a couple weeks into January, assuming if January even holds up. If January is a bad January, then all bets are off. I wouldn't trust it. I wouldn't trust this stock. Okay, RX. Oh, yes, this one. So this is AI on pharmaceuticals, right? Yeah, this thing is a beautiful one. So, I should, in theory, like I bought below 6. And usually when you get to 8, you would sell, but I decided this time around I'm not doing that. I'm just like, I think this is going to keep going up. And then this week, at the end of Friday, it's up 21%, recovering the losses of the past couple days. So now that we're back at 8, and if I believe XBI, right here, you see this? XBI, the biotech sector ETF, is going to break out and go to 105 or something like that, then yeah, RX would be a very good stock to be in. So I'm thinking of adding. Another one is you can use leverage. LabU, LABU is 3x XBI. So the ETF XBI, you have a 3x version, LabU, LABU. So yeah, you can look at the tickers that are scrolling through your at the bottom banner here. You can see that I put a leverage list, so you can research these yourself. But LabU would be one of them, and the other one would be like you can do ARC-G, Kathy Wood's genomics. So we can start looking at these too. I think during the week I'll be looking to see what genetic stocks. So any kind of genetic testing, damn, there was a genetic testing stock that was really good. Freaking hell, was it VST or something? Vistra? I don't think it was Vistra. Oh, dang, I forgot it. All right, I'll remember. I mean, it was like several weeks ago, I think, now, when I talked about this stock. Oh, darn it. Okay, I'll remember it later. Let me see. Let me write it down, though. I'll have to look for it. Look for genetic testing SPAC stock. So I gotta go look through that list. Yeah, we got. It's not VST. That's not it. So ARC-G, that's one. And then, Yeah, and then I was mentioning TARK, so you can use TARK for 2x leverage of Kathy Wood's ARK. Okay, so definitely something I would probably start recommending now as we get into, but hold off on buying these, maybe this ARK and TARK and all that, maybe into when we get closer to Jerome Powell and into options expiration, because we'll have triple witching options expiration on the 3rd week of this year. I mean, this month, right? So that's the 20th of December. Wait for that. So go from 18 to 20th. So watch how the market is doing leading up into talking to Powell, leading up to the 18th, and then after the 18th, see how it does into the 20th. And then by the time we get to New Year's, like really get aggressive. If we really have to get aggressive, we need to, yeah, we can start buying a lot more. But for now, just take profits of whatever positions you have. Like HIMS right here, it's about to break out. HIMS, so it's been like, man, this thing was probably good to day trade every day. Pump in the morning, dump, pump in the morning, dump, pump in the morning. But if you look at it, like you see this, it's making a channel right there. So that's what we call a rising channel. If you make a rising channel, most likely than not, it's building a lot of energy here, a lot better than you would think, because it's not going a sideways or down. Then when it pumps up, when it's ready to pump, and it could happen this Wednesday when the CPI goes good. So if XBI starts flying, like I could see this thing just really, really making a move to 40 to 60. Yeah. Really 45, 60. Yeah, this thing could really do it. Because there's no right here, there's no history. We're in all-time highs right now on HIMS. So I'm watching this to break out. I might add it, I might add to it. I don't know yet. I haven't decided. Because I'm already up 60% on this damn thing. I don't know. Might be risky. Yeah, we'll see. We'll see. We'll see. Anyhow. Okay, what HIMS covered that? Zim covered that. AOI. Okay, AOI. AOI, this one is a really garbage company. Very terrible. CEO, I listened to their earnings calls like several years ago. Very terrible. Like they just have a one customer syndrome where all their revenue is just based on one customer. And back in the 2018 era, like here, you see this from 2016, it moved from like $10 to not $100. This was all because of Facebook. I think right now it's because of Amazon. That's their customer right now for optical networking chips and cables. So it pulled back just below this breakout area of 37, and it pumped back up. It recovered a bit on Friday. I'm watching this. I don't know if I really want to play this again because yeah, you could have played this several times, but I don't know if I want to jump back in. This might be a really high risk to play into the New Year's, but overall, since Marvell's earnings, a lot of these stocks like Light, Lumentum, Coherent, COHR, Lumentum, LITE, they're showing good signs and characteristics that could probably go on into the first quarter next year. And if they're doing good, it shouldn't be a problem for AOI to follow it because it's going to take a while before it gets to the next earnings, right? Next earnings for AOI will be February 20th. So you got a lot of room right here. If this thing is just going with the flow, this stock is way easier to move than Coherent or Lumentum. So I don't give a crap if this company is trash. If I can just trade it really quickly to like 60 plus, if this thing hits 60, right? Man, I could see a crazy squeeze back to the old highs. It shouldn't be a problem. This is very easy the stock to manipulate. So if you catch it on the right side of the manipulation, man, AAOI, yeah, high risk, very high risk. I don't know if I would recommend it necessarily, but it's something I would consider, in your list of things to gamble with. So there's something there. Okay, next one, JKS. JKS is solar. We got the solar stock right here. JKS. You see that? You see this? You make that new low, you undercut it, and then you bounce on China, and then now it's doing this because now that Trump got elected, you have the China effect plus like solar companies are going to get beat down. But look at it last week. So up 21%. You see it's trying to hold, and then you see these moving averages, the 18 and the 40. The 40 starting to flatten, right? The 40 week starting to flatten, the 18 cupping around, and then you have this shape here where when I put this box, look at this area. The way it's moving, it's making higher lows, right? Since September. Yeah, it wants to go up. It wants to go up. Also, high risk because you have the China effect plus the solar effect. And it moves very quickly. But like I said, a lot of you guys want these type of high beta moving stocks. This is the one to get, but you got to get at the right points though. You don't want to buy here and sell there and then just be like, yeah, you keep buying at the top and selling at the low. You got to look at the chart, look at where it's going. You got to strategize. I'm just going to buy at the right point. This ain't the time to buy. Wait for it to pull back maybe again. If this thing pulls back and it goes to a higher low, let's say it goes to 24 or something, never even drops back to 23 or 22, that's it. Then the next move is like it's going to jump back to 40. So yeah, just think about it. Think about it. Nova. So we did the first move, drop on Trump, down 45%. So it had earnings, then Trump, boom. That whole week, 45% recovers. Now it's moving back. What you want to see is it holds 4, it tries to get back to 5, and then on we go back to 7. This is what we want. So Nova is another one to look at. This is a solar company as well. Okay, another one, Mobileye. This used to be owned by Intel. They spun it back out, so it's a subsidiary or something. I think it's an independent company at this point, but Intel has a lot of shares. They still have a lot of shares in it, so maybe it'll be bad news coming, or Intel has to dump most of its shares away if it comes back to 15. So this weekly chart, you see this thing cupping around. Yeah, maybe 15 is a place to buy. Try to get back up to 18 and then go on to 21 and up. So Mobileye, I think they do LiDAR. I forget. They do LiDAR for EVs, autonomous vehicles and EVs and stuff like that. I think when Tesla was saying they didn't like LiDAR or something, it got hit. There was a lot of LiDAR companies that got hit. Probably here, maybe this was, I don't know. Maybe this was before they got spun back out. I forget. But at the point, yeah, this stock was kind of beat up. So it got beat up so bad from 44 down to 10 this year in September. So yeah, another bottom feeder stock that looks like it's going to finish up its base real soon. So look for that one. And then we got another one, Affirm. Okay, very good. See that? Perfect. You have this down going channel. You make an undercut. So people here thought like, oh, shoot, it's going to crash. Nope, wrong. It reverses. Then it shoots right back up, right back to the top of that channel, and then breaks out. Perfect. Beautiful. So you got that 2 horizontal line structure. Like you got 26 and 47 between those two ranges, which were set back in March 2022. And then again in September 2022, before the last drop, you make a base here, you go up, and then you go down. Now, you see this? You can look at this like a parallel structure going up, right? And then once you do that, you break out. So now what I'm watching is, will this continue? If this thing continues on to the new year, so wait until January for this one, AFRM, Affirm, and a lot of these stocks that do fintech, Upstart, UPST, same thing. You see, you go back to this resistance, old resistance from way back when, set there. Now you wait, you see if it pulls back and jumps up. Once it jumps out, you can continue. Four, F-O-U-R, see? Now it's testing this again. It's testing that point, 103. 103 was set back in April 2021. You break out, you pull back, you test. This thing can make all new time highs. All these are part of the same thing in ARKF, A-R-K-F, Kathy Wood's FinTech Innovation ETF. You see, this has been moving up since November 2022. And now, so this is probably, so this has the combination of financials and technology. Financial stocks have been doing quite well because now we know that interest rates have reached their peak. So if you look at the XLF ETF, see, these are banks and insurance, and KBE only banks, no insurance. They've recovered quite nicely. So now you do ARKF, you're looking at companies that do financial and technology. I believe Upstart, a UPST, they do AI to do loans. Four, I don't remember what Four does. Shift Four Payments, probably a payment processor. Affirm does buy now, pay later. Okay, so those are what those are. So look at those. Look at those three. Look at that whole sector itself. Okay, good. I covered that, and we've got two more left. ACHR. ACHR, Archer Innovation. And since I'm looking at this, okay, so I talked about this briefly in the last stream. So, you know, I told my cousin to buy this thing. She buys it somewhere at 6 or 5. It goes up to 9, 10. It crashes. She panics. She goes like, should I sell? I said like, nah. And I said in the previous one, the reason why is because the conditions have changed. You know, the market conditions have changed. They favor stocks like these stocks that make no money. They're very experimental. So ACHR, Archer Aviation, Joby Aviation, Joby, and Blade, BLDE, Blade Air Mobility, they're all in the EVTOL sector. EVTOL. So you can look that up. That's electric vertical takeoff and landing vehicles. So it's like Blade Runner, right? We have the flying cars or the Jetsons. So that's what they do. So that's kind of like more future tech stuff. So they're trying to say like, yeah, the future will just have flying cars or taxis. Anyway, they're trying to do flying taxis first. Not gonna do flying cars. Nobody can afford that. Yeah, Mobileye. Yeah, I remember that. Tropes. Yeah, Mobileye did a partnership with Lyft. Yes, that's right. Okay, so let's see. I do have other craps on the list, but I'm not going to talk about those. They'll have to prove their worth. They're too volatile and nasty. I mean, it's kind of like the quantum computing ones. I mean, I put them in the banner, but these things are just too scary for most people. I think for people that just want to day trade, they're definitely good at that. Like, see, they go up each day 30%, 20%. Like, but yeah, maybe I'll talk about them this week if things go well after CPI. But because you can see like IONQ looks like it wants to break out. QBTS, it did this where it tested that support and broke out. And then QUBT looks like it's making a cup formation here. Maybe it's gonna break out. So yeah, but they're high risk. I don't try to advocate people playing them. Now, the last one I want to talk about was NNOX. This is Israeli company. They do some special form of X-ray CT. They got FDA approval to Thursday, and looks like finally. And I was talking about it when it was making the lows again at 5 something, and looks like maybe I will add. Maybe it's time for this stock to really move because this thing is a piece of trash. But if you see this, yeah, I like that. I like this formation. And then you do that at the bottom of a very important low right here. See, this whole area here is a low. You do that, and now you're breaking out. Then yeah, can you go from $8 to 20 something dollars for me? Maybe. It's possible. It's definitely highly possible. It IPO'd at $21. It can 8 to 21. Yeah, do that for me. That's a good trade right there. So yeah, we'll see. Maybe I'll add to it. Okay, I think we're done with that. Do I have any more videos to play? I don't think so. I was gonna read an article and then I was gonna go over the earnings. Yeah, I was gonna go over the earnings, but let me read this. Let me read this article first. Take a break from looking at charts. Oh, man, this stuff is so much work to look at charts. Man, Stanley was talking about like Internet Archive. I was surprised Stanley didn't know about Internet Archive this morning. You know, there's a lot of alternatives to finding free books out there that are not Internet Archive, but maybe one day we'll talk about them. Yeah, it's good. It's good to talk about some things. Yeah, man. Yeah, getting free information is always nice, especially you got to get the financial information. All right. Man. Where's all that stuff I want to talk about? God, I have so many tabs open. Hello? Where'd you go? Where'd you go? Where'd you go? Why did I even look up this stuff? Wow. Okay. Looks like maybe I closed those tabs. Let me see. Let me see if I remember it. Market efficiency. I was doing because last stream I was talking about random walk. Okay. So I don't know if you remember that. And I want to talk about the random walk. I had that. Man, that's weird. I had that random walk. Down South Street. Okay. Okay, here. All right. And then I found this article. Okay, perfect. I found this article. It's a very nice article. Okay. All right. Okay, now I'm gonna find StreamYards. Okay, let me get this and then that. All right. Okay, set everything up. Okay, guys, I set everything up. All right, let me share the screen for you. Okay, this is a very nice article I found. Really nice one. Okay, and I'll put this one here. Okay, so this one, I put the link in there. Okay, let me put the background music so we can get to music while I read this whole dang thing, because I think this one's really worth talking. So we're gonna close it out with this, and then, well, maybe if I have time, I'll just go over some of the earnings tickers I want to talk about. Let's go. Market efficiency versus digital finance. Which strategy delivers better returns? Okay, this is Scott Lanigan, CFA. Now, before I go into that article, let's do some background. So there was this book in the 70s called A Random Walk Down Wall Street. And this one was written by an economist from Princeton. So it's a book on the subject of stock markets which popularized the random walk hypothesis. Random walk hypothesis is a financial theory stating that stock market prices evolve according to a random walk and thus cannot be predicted. Okay? So this guy back in the 70s said, you cannot predict anything going on in the stock market in the short term. So this is where people get the idea that they can't time the market. You can't trade. You should just invest, and that's it for the long term. So he argued that asset prices typically exhibit signs of a random walk, and thus one cannot consistently outperform market averages. This is very important. So let's say I make a lot of money 1 month, but then 2 months later, I just lose a lot of money. It's random because I can't predict it. So maybe I get lucky one time, I pick the right outcomes, and the next time I'll just give it away. So I gained and then I lost and I returned to the mean. This is when people say returning to the mean, right? It's statistics. So if that's true, then you just have to listen to the trend. There's only trends. And if there's no trend, you don't invest. So all you're trying to do is you are trying to get to the point where you are following the trend. So there's a lot of trend following theories, right? Where you just go look at a long-term chart and you try to invest. And that's why most people, they just choose the S&P 500, for example. Most people would just do that. They're so lazy, they can't pick any stocks correctly. So not only are you can't predict anything, you also can't even choose the right companies. You rather just let some organization choose the 500 top stocks in the large cap stocks anyway, the S&P 500, the largest companies, the best of the largest companies in the US, and then don't think about it. That's it. That's what most people do. They just don't believe in timing. They don't believe in any of that. All they want to do is just follow the trend, follow what everyone else is doing. Your job as a trader, you need to beat that. So if the S&P 500 is up 5% in the year, you better be doing better than that 5% in that year. If the S&P 500 is down 5% in the year, you don't even need to make money. Actually, all you need to do is actually beat that loss. So you just need to lose less than the market average that year. So you could lose 2% and you still win. So if you can say, if it's up 5% and I make 10% and it's down 5%, but I only lost 2%, then that's it. So if I can consistently always beat the S&P 500, that's all you got to prove. And then you get customers for your hedge fund or whatever it is. Okay, that's all you gotta do. The book is frequently cited by those in favor of the efficient market hypothesis. This is big. Okay, this is big. The efficient market hypothesis in financial economics. Okay, this states that asset prices reflect all available information. All right, a direct implication is that it is impossible to beat the market consistently on a risk-adjusted basis. All right, okay. So anyway, here's what the book summarizes. It examines some popular investing techniques, including technical analysis and fundamental analysis. Technical analysis is what we're doing right now, looking at charts. Fundamental analysis, that's what Martin Shkreli likes to do, look at all these SEC forms and try to figure out what, and go to their websites or look if the CEO is bald or fat, and then decide if I want to buy that company or not, right? So in light of academic research studies of both these methods, through detailed analysis, he notes significant flaws in both techniques, concluding that for most investors, following these methods will produce inferior results compared to passive strategies. So this dude hates on both me and Martin Shkreli. He says that most investors, they're not good at anything. They can't even do anything that will help them beat what, the banks, the hedge funds, and all these guys. So forget it. Give up. It's better you just buy the S&P 500, turn off your brain, and this is how you're going to win. That's it. Okay, so that's the goal. Now we get into the article. Okay, remember, article, market efficiency versus behavioral finance, which strategy delivers better returns? So there's two people here. So they got two quotes. All right, let me go to the quotes. So this is by Eugene Fama, something like that. I'm the most important person in behavioral finance because most of the behavioral finance is just the criticism of efficient markets. So without me, what do they got? Now this quote by Richard Thaler, that's German. Okay, Gene has it all wrong. If it were not for behavioral finance, he and French would have had nothing to do for the past 25 years. He owes me everything. After reading these quotes from Fama and Thaler, you may conclude that they are bitter rivals, but this is far from the case. Fama and Thaler are business school professors at the University of Chicago and well-documented golf buddies. But despite sharing the occasional 18 holes, there is very real underlying tension between the two. Fama is captain of Team Efficient Markets, and Thaler is captain of Theme Behavioral Finance. Each represents conflicting academic market philosophies that have been warring for years. It's the academic equivalent of Lakers versus Celtics. Team Efficient Markets believes that market prices reflect all available information and are therefore efficient. Its strongest proponents believe that risk-adjusted performance over long time horizons isn't possible. Over time, the philosophy expanded to include risk factors. Investors can be compensated by tilting their portfolios toward risk factors to achieve higher returns. This team believes that because these factors tilts represent increased risk-adjusted performance over long time periods isn't possible. Market efficiency proponents argue that if empirical evidence shows long-term risk-adjusted performance was achieved, investors didn't achieve it due to skill, but by tilting their portfolios towards a previously unidentified risk factor or by dumb luck. Buffett's Alpha deconstructed Warren Buffett's phenomenal track record at Berkshire Hathaway into different explanatory factors. The paper won the Graham and Dodd Award for Best Paper in 2018. The award recognizes excellence in research and financial writing in the Financial Analysis Journal. Although the authors concede that Buffett's track record was not due to luck, it's hard to read the paper without coming away with the feeling that its purpose was to knock Buffett's performance down a peg. So Team Behavioral Finance, on the other hand, believes market prices reflect all available information most of the time, but that market participants are also influenced by behavioral biases. This behavior leads to market inefficiencies that can be exploited to achieve superior risk-adjusted performance, even over long time horizons. Regarding factor investing, the behavioral camp believes that risk factors represent price over value gaps due to behavioral biases rather than an increase in risk taking. As it pertains to Buffett, this camp is more likely to believe that his track record is due to his even-headed decision-making skill and access to unique information sources. Okay, so that's just looking at two ways of one way, two things. You're looking at Buffett's performance going in two different directions here. You can look at it this way or that way. So let's continue on this. We can have some graphs at the bottom of this thing. Unfortunately, many issues arise when debating market anomalies. The main two issues stem from hypothesis testing difficulties. How would you test for behavioral biases? And the subjective interpretation required when the market anomaly is discovered: increased risk, behavioral inefficiency, or spurious correlation. But fortunately, Fama and Thaler's respective philosophies heavily influenced two major asset management funds, Dimension Fund Advisors and Fuller and Thaler Asset Management. DFA's founder, David Booth, served as a research assistant under Fama while attending the University of Chicago in 1969. The firm's investment underpinnings rely on Fama's academic research, leading it to tilt their portfolios towards small, cheap companies with higher than average profitability. Fama also serves as a director and consultant at DFA. As the name implies, Thaler co-founded Fuller Thaler with Russell Fuller. The firm seeks to exploit behavioral biases to outperform markets. Like DFA, the firm also tilts its portfolios towards value and size factors. Unlike DFA, the firm seeks to exploit the loss aversion bias, believing that investors overreact to bad news and losses and underreact to good news. Okay, see that? Both firms have an investment fund with a long track record and the same benchmark, the Russell 2000 Value Index. Figure 1 pits the competing philosophies against each other and the fund's benchmark. So you see this graph here, right? So if I bought $1 in both of those funds, and then I also buy $1 in the Russell 2000, so $1, if I just track it, so who wins here? Who wins here? So this is figure 1, DFA's US Small Cap Value Portfolio, DFSVX. And then the Fuller Thaler's Undiscovered Managers Behavioral Value Fund, UBVLX. And then the Russell 2000 Value Index. You see this? So the behavioral team won $17.19. So if I bought $1 back in 1998, I'm up $17 to $17.19. If I bought $1, it only became $13.95 if I used the efficiency team. So the guys that believe that it's random and the market is efficient. So it shouldn't work like that, right? But either way, both of them do beat at least the Russell 2000 value, which only got to $8.88, right? Right here. Now, Team Behavioral Finance outperformed Team Efficient Markets by an annualized 0.91% between December 1998 and July 25th, 2024. But many readers may disagree that this proves Team Behavioral Finance's victory because the results don't account for risk taken. Fair enough. To test this, I applied Jensen's Alpha and only used the Russell 2000 Value Index as a benchmark. For the risk-free rate, I de-annualized the 3-month Treasury rate. Okay. So now we just kind of normalize it in a way. So I think, this will be good for Portia to do. Like this is a lot of actual math here. There's applied mathematics. So you can look at the bond rate and then use that to adjust where the risk is and this and that. And, you can go back to the October streams. I covered risk. And man, I forgot what I talked about though. I had some example about that where I discussed risk. I think I forgot what it was. I read an article. I think it came from Stanford. it was like a Stanford class article or something like that. It was a lecture, and I read that whole thing. I thought they had a very good example. This is why you pick bonds and stocks. So the traditional way is 60-40 portfolio. If you think something bad is going to happen in the markets, the economy cycle is not going to be good, so you think there's a recession, then you're 60% bonds, 40% stocks. And then when everything is fixed up, you have an economic boom, then you're 60% stock, 40. This is the 40% bonds. This was the traditional way. And then I go through that whole example and showing you why it works, because there's risk free. So you have to adjust for risk. So if I do something like GameStop, right? Yeah, of course, theoretically, I can go up like 100, 200% in a couple months, but there's a high risk associated with that. Unlike with a bond, okay, a bond might only give you 5% over the whole year, let alone like 1% in a month. But at least there's no risk, theoretically, assuming the United States doesn't implode, right? Or you have like high inflation. Those are the only risks with bonds. Bonds are only risky when you have high inflation, okay, which was what happened in 2021. And if like you don't believe in the United States anymore and can't pay a debt, it defaults, right? Those are only two exceptions to that rule. But anyway, you look at that, they normalize the whole graph, so it's kind of like it looks more in line instead of like going up in one direction. And then what happens is once we take that into account, so after accounting for risk, team behavior still comes out on top. This is nearly confirmed unanimously throughout all risk-adjusted return metrics as shown below, apart from the information ratio. I don't know what the information ratio is. This must be some jargon in finance that I have to look up, but the battle of Booth risk-adjusted returns. So team behavior, let's see. Geometric average 11.79%, team efficiency 10.88%, and Russell 2000 8.93% geometric average. All right, so Sharpe ratio also is a financial. I'm not going to get into Sharpe ratio. And then you have the beta and alpha, also finance. I don't remember what information ratio is. Probably the ratio of these two things, the alpha and beta or something like that. But this is all finance stuff. It's not a finance class in a way. I'm not going to get into like all that. Even I'm not that deep in the knowledge of finance. So I think maybe John could tell you this stuff. Yeah, actually, yeah, you could, tell John to like go over this because he can. He took the CFA test. Yeah, I think he passed them, right? He passed level 1 and level 2. Oh, level 2 is way harder. So that's the CFA. CFA. Yeah, there's level 1, level 2. I think he said he passed level 2. There's also a level 3, I believe. I don't know if he took level 3, but he would know all this. Like, he would read this and tell us what all this shit is. So this is getting to the nitty-gritty, all right, of things. Now, despite the results implying that investors can exploit behavioral biases even over long time horizons, strong market efficiency believers may be hesitant to change their mind. If so, I encourage these individuals to check out their own behavioral biases to ensure they exhibit the same rational traits that the market efficiency hypothesis assumes are true. Okay, this is a very nice article. All right, so I think so. This dude CFA. Oh, he's in previous work at the family office in Dallas, Texas. EID. He's a sole owner and operator of EID Capital. So Scott Lanigan. Yeah, this is a good article. And I think the debate still rages on. This is something that won't be decided just by this guy. People will always argue about this stuff. This is a philosophical debate. But what I tell you is, I believe in behavioral finance. I believe that you can time the market for the fact that humans, they will always react the same way to certain stimuli in the end. And you can exploit it. And you can think of it like, I think in last night's stream, HB was there, and then we were talking to each other. I just said, like, it's like thermodynamics. I think thermodynamics is a good way to model this. You got that Brownian motion. You can think of that as random motion, but the efficiency of the market isn't 100%. So like your internal combustion engine, your gasoline or diesel, whatever, at most maybe 30% efficient, right? So it's not like an electric motor like a Tesla. And if it generates heat, is it purely random heat? I don't think so. That heat can be like, there's a cycle to that heat, the way that heat expands and comes out of that engine. And if you can predict it, you can predict the temperature variations and whatever, you can put something to capture that energy, so that energy becomes your money. That's the capital that flows in your pockets. So everything you can think of as a transfer of information, a transfer. Yeah, actually, if we think about quantum physics, that is a transfer of information, right? So actually, me generating heat is just like a binary code going through space, encoding something. Yeah, okay. That's really philosophical. Now I'm getting really, like, I'm just turning this whole discussion to metaphysics. No, we're not going there. But yeah, it's something to think about. I think there's a lot of things you can think about in those terms, and I like to think in analogies, so it's a good way to do it. But let's go back to some charts again. Let me wrap this up with some extra topics. All right, we're gonna discuss earnings, some earnings that showed up. So I got a list of earning stocks. It's in the description. So there were past week earnings. So we can go through some of these. We had Lululemon. Yes. Up 24.62% for the week. So yoga pants are back. Perfect. Right, so we got Lululemon. I talked briefly about it. Ulta, right? Sephora, all the makeup. Victoria's Secret, VSCO, right there. And then there's HPE, so Hewlett Packard Enterprise. I think this is a breakout. So we got this whole formation since 2018. Now it's breaking out. So there's a lot of stocks like this, like Deere. So DE is Deere. You see this? Yeah. And then you have Tesla, same thing. You have breakout right here. So you can see this, and then you go look there. Yeah. So that's a breakout. And then you have Honeywell. Let's see if Honeywell is breaking. Maybe I remembered. Oh yes, I was right. You see that? Honeywell. So it's kind of like defense, and they have thermostats and whatever. I don't know. Honeywell is like kind of like a really big, multi-faceted company. But yeah, look at that. It's making this huge base up back in the 230s. Yeah, so we gotta watch these type of things. Let's see what else. What else for earnings? Kroger. Yeah, I briefly mentioned this one. Kroger, Albertsons. You see this cup? It has this nice cupping. You have the bottom base right here, and then you cup right here. So then you got this nice, really larger structure. Yeah, Kroger might break out too. Cracker Barrel, CBRL. You see this? Down. Okay, it hit a low, 35, bounces back up to 50s, comes back, already has earnings. So it pulls back on earnings. It might hold 45, 50. And then from there, it can continue on up. Maybe, yeah, this will be one of those bottom feeding New Year's type stocks to get into. Okay, what else? Sentinel One, BBW. BBW is the bear making company, right? Build-A-Bear. Yeah, this was a nice stock because it was kind of like a meme stock during the 2020s into 2021. And then it went nowhere from there. Since it hit 21, it just went back and forth. And then December 2022 into now, it's been making this upward moving channel and then breakout. So I don't know what this earnings would do. It's only up 7.98% last week. Could be something I might be interested in for next year. because it makes this pattern. But maybe it's something that will just only go up into January and break down. That's it. Okay, Wolf, WOOF, Petco Health and Wellness Company. So we got $27. Was this IPO or something? I don't know. Goes down to 1, shoots back up to 5. Yeah. Very good characteristics for next year. So watch that one. 2 really strong earnings reports from these software companies right here. Asan. Okay, ASAN. So Asana Inc. Somebody told me about this company way back in 2021. It did its pump, it did its dump, it's doing its base. Now I'm interested. See, it broke out of this. You see the 16 area, 16, 17. You hold your base down here, 11, 12. Now you break out, go to 2022. That's it. Yeah, so you got 22, and then you go into like next year. That's it. I'm liking this. DocuSign. So you make this base, you finally recover. Now you're breaking out. Yep. It's $106.99. Yeah, wait for the pullback. So wait for this. So this whole 18 moving average, weekly moving average, wait for it to come up, and then wait for this 40 weekly moving average. Wait for those to come up. Yeah, I'm definitely interested. Charge point, probably like they do EV charging. Look at that. Crash. Now it's $1. It could be a garbage stock that might work. I don't know. Not really convinced that this thing might do it, but yeah, I'll pay attention to this one. So CHPT charge point. Okay, so those were the stocks to look at. Oh, there was 2 more. Okay, let me see. I missed. So did I talk about Vive yet? Yeah, Vive and Path. Okay, let me do this. Viva Systems. Yeah, similar thing. You got this base, 250 VEEV. Yeah, I'm gonna watch this for next year. Path, PATH. Bottom feeder went to 11, 14. Yeah, I'm watching this one too. GitHub Labs. Yeah, it's making a nice base here. Already had earnings. Okay, yeah. Let's see. So a lot of the software companies, those 3 are software. All right, so we had Chewy. That one had earnings. So Chewy is just because it's tied to GameStop in a way because of Roaring Kitty. Then I was talking about Dollar Tree, right? DLTR, and DG, Dollar General, DG. Okay. That's it, covered those. And then last one was something someone mentioned, IoT. I remember this. And then it had earnings. It's been rising, so it had earnings. Lots of volume, pulled back down to 57. It went down for the week of 5%, but it's still above 48. It's still above 50. So, okay, let's see how this goes on the New Year's. It's one of those trending stocks. And I think next week, we have AZO earnings, AutoZone, another trending stock to watch. Tuesday, December 10th. O'Reilly won't have it till February, so it already reported earnings October, so it's done. So yeah, AutoZone. Those are 2 large parts retailers that's made. Yeah, it's done. It's one of the better performing stocks that you could possibly own in the long-term portfolio. And then next week, what else? We have AI I talked about. I talked about Planet Labs, PL I talked about. So I already talked about those 2. So let's refresh your memory. AI might break out, okay, on earnings. And PL, Planet Labs. Yeah, it's already broken out, but has earnings. So it's already broken out this level at 3. It tried to hit 5. It pulled back to 4. So I'm watching this because it's going to be tied into the other space stocks, AST Space Mobile, Lunar, LUNR, Intuitive Machines, and Rocket Lab, RKLB. Shkreli bought it up here at the highs, so I don't know if that's a good idea or not. And then let's see what else we have. Toll Brothers Homebuilding Stock, TOL. Watch this one. See if this affects the whole sector. But it's a nice trending stock. It's from 2022. Very good. So yeah, see how that affects ITB, the ETF. All right. So I'm not. I haven't decided on this sector if it's time to go or not. And then talk about GameStop. GameStop has earnings too. Avago. Yeah, okay. Let's see. Avago. This is the most important one. And this one had the options, okay? Yeah, you have this. Let's see. Let's see if it breaks out. This is very important. So Broadcom will be the decider for semiconductors this week. So that will affect your SOX L. If you got SOX L here, 27, 25, and you think you can get to 40, that's it. We're reliant on that one. And I'm going to talk about these other ones for earnings. Let's see. Oracle. Very important. Oracle. ORCL. Yeah. It's trying to make new highs. So that's one's going to be important. ORCL. And then SFIX, Stitch Fix. Yeah, it's one of these bottom feeder stocks. It could be good. It used to be like 100 something in January 2021. Yeah, all right. And I think we also have something else. Play. So Dave and Buster's, right? Play is gonna. Yeah, okay. It's been going sideways. Yeah, it's pretty much since the pandemic. It's just like it just recovered and went sideways. Yeah, I don't know. This one. I think I will only be interested in this one in the sense that like it can tell me how good the economy is, because if people spend money on places like Dave and Buster, it starts turning around. I'm going to get more optimistic about the next 2 years. So yeah, that's something to look at. And then Macy's. Yeah, Macy's will have earnings this week. Or did they have earnings already? So I don't know. I think that's a mistake then. Okay, so the list that was put on eWhispers is a mistake. So it's probably Macy's and not going to be the next earnings. That's wrong. So let's see, Adobe, or maybe his TradingView is wrong. I don't know which one's wrong. I'm not going to look it up right now. But Adobe, yes, software company, very important. Okay, yeah, I'm going to watch this one too. If Adobe does well, that's a good sign. It's a very good sign for the overall. And then I'll be more optimistic about Doku, Asan, Vive, Path, yeah, all the other ones I listed. And then the last one was Costco. That's going to be the last big one for the week. Costco. Yeah, it's already at a new high, $992. If Costco does well, and that's it. Good sign for the next coming year. Okay, so Costco's next up. So that'll be the last of the major earnings, and we're done. We're pretty much done for the year. All right, we just have to wait for Powell to talk on the 18th, and we're finished. Wrap up, close up the year. Very good year, very bullish. Bears got wiped out, I guess. That's it. If you want to be a bear, wait for January. Maybe I'll change my mind, short everything, and the whole stock market can collapse. But for now, we keep going up. All right, Bitcoin. Let's double check how Bitcoin's doing. Oh, what is it doing now? Still schizophrenic. Let's see, 99,000. Yeah, still doing nothing. So it bounced up, retest the low again, still do nothing. Let's see what happens in the morning. I don't know. And let me see what pre-market is for SMCI. So like I told you guys, SMCI, I'm probably going to dump most of it, if not all of it, tomorrow. I mean, it's pretty close to 50 already. It's 49 still overnight. I don't know what's going to happen pre-market until the open. But SMCI and then SMCX, okay, is the SMCX. All right, SMCX is the 2x leverage. So yeah, this will be over $100 tomorrow morning. SMCX, the 2x ETF of SMCI. SMCI should be 49. SMCX over 100. That's it. It's time to get out. Then it's time to get out. I need to get that money back, so I'll just add on to stuff like HIMS or some other crazy biotechs like LabU or maybe some Cathy Wood ETFs in next week, in the coming week. Okay, the next week. All right, yeah, it's not the coming weeks, it's the next week. All right, hope you understand. Wait for Powell to talk, then we'll get back to you on what I'm gonna use that money for. But for now, yeah, start closing out stuff this week. All the winners keep on winning, then you just take your profits and we'll be good. And then we'll have a very good year. You can spend it on presents or whatever you want. Spend it on yourself. We'll see you next year. So this is the prequel. And if there's something funny happening around New Year's Eve, so remember the trading a day, December 31st, they're still trading, and then after New Year's, January 2nd, they'll be trading. So remember that. You got Wednesday. It's landing on hump day. New Year's lands on hump day. So you look at what the behavior is on the 31st, and then look at how the trading works on the 2nd, and then we'll see how January goes. January will set the tone. Yeah. So if I want to go short, I'll probably tell you on New Year's Eve I'm gonna short that New Year's ball, right? Short it. All right, guys. Later. Oh wait, let me play the commercial. Yeah, let me play.
Feel like I should go. Feel like I should go. Feel like I should go. Feel like I should go.
All right, good night, guys. I think Process's dating show is still going on, and yeah, you can go on a 24-hour stream. We still got going with John, and yeah, later.